UK inflation increased to 2.5% in June, sharply ahead of expectations for 2.1% and considerably higher than the Bank of England's 2% target. This is the third month in a row that inflation came in above expectations, raising concerns that rising price levels could be permanent rather than transitory. Meanwhile, yesterday, US inflation hit a 13-year high in June, putting pressure on the Fed to look towards more hawkish policy. Joining me to look at a few charts is Serge Berger from thesteadytrader.com. Serge, great to see you as always. So we saw a bit of a delayed reaction yesterday to the US CPI data in the Treasury market, with yields on the 10-year and the 30-year rising in the afternoon. What have you been witnessing in terms of the charts?
Hey, Victoria. Yeah, it's. I think we're in a general in sort of a digestion period. It doesn't really matter whether you're looking at equities or fixed income, and it's largely because we've had a really big run, whether that's bond yields in the beginning of the year and of course starting last year, or the reopening play on the equity side. I think right now when I talk to fund managers and just look at the fund flow, I still think we're going to have higher yields, but we are having some headlines around more a spike in COVID cases again. We have the summer lull. I think people are a bit tired of working for the past 12 months nonstop, maybe taking some time off. So I think all that feeds into just a further digestion period. But I would suggest that the next 25 basis points, just taking the US 10-year as a reference point, are likely higher rather than lower. And even if we were to pierce below 1.2%, it probably wouldn't last very long. I think the inflation data will continue to remain fairly accelerated to the upside. And the question, of course, is, as you point out, is it transitory? The question I always ask is, what does transitory mean? Is that a few months or a few quarters? And I think if you look at this through at least a few quarters, maybe a year or two of somewhat higher inflation than what we've seen, then I think you can easily get to a 2% 10-year, but probably not a heck of a lot above there for a stale period of time.
So last week we saw German bonds move in the biggest 2-week drop since March of 2020. So that was just after the massive sell-off that we got in the equity market at the start of the pandemic. What's your take on the recent moves that we've seen in terms of European yields?
Look, I think it's the same story. What I continue to look at is a reopening story. So what we had the first reopening story really was in Israel. Smaller market, if you will, since it's one country as opposed to a continent. Then it was the US, and I think it's Europe now. So what we're seeing, again, as I said before, is a bit of a spike in some of these Delta variants, and due to not only that, but also, again, people are out and about, younger population, all that kind of stuff we read about. And it does make sense that yields will come off a little bit. But I think ultimately, let's keep in mind that German 10-year yields are still well in the negative. We got as close as, tickled the minus 4 basis points mark. Now we're closer to, minus 30 basis points. Again, I don't think it's going to take that much in terms of the further reopening and another sort of, seeing these cases not spike much longer for these yields to go back, potentially towards the zero mark on the 10-year in Germany in the not too distant future.
Let's switch focus now, because US earnings season is kicking off for the second quarter. Yesterday, we heard from JPMorgan and Goldman Sachs. But despite beats on the top and bottom line overall, both stocks were ending the session in the red. We've already been talking about fixed income. And it felt as though with JPMorgan, it was this real disappointment in terms of fixed income revenue, down 44% year on year, that was weighing on that stock. What's your view on the US financial sector right now? And do you think that this sort of minor sell-off that we've seen is an opportunity to buy the dip?
Yeah, I do think we are going to see somewhat higher prices in the financials if you look at it through sort of a 6-month lens. I think it plays into the broader digestion, or if you want to call it an indigestion period, that we are continuing to see in the equity markets, Europe, US, and elsewhere. It's kind of like a rolling correction, and I'm not quite sure the financials have a lot of upside in the very short term. I would think pullbacks should be bought rather than sold in the very near term. I wouldn't be surprised if we start to see a bit of a further pullback. So tactically, I would be more short than long from a pure trading perspective. But any pullbacks as we get through August, maybe September or so, I'd be a buyer of as we start to hopefully then get to the other end of that broader rolling correction in the market as well.
And just switching focus again, I know you've been focused on the media space in some of your research lately, particularly Viacom. This is a stock that you've been looking at, which could be in play as a potential acquisition target, given the current dynamics in the sector. Talk to us about the opportunities you see here.
Yeah, very interesting, more of an idiosyncratic story there, meaning it's not so much the broader market, but rather what's going on in that particular space. This is one of those stocks that was first of all, it rallied very strongly early in the year, and then basically with the Archegos scandal, if you want to call it that, essentially got obliterated, and now it's consolidating. So there's a lot more talk out there now of media consolidation. We've seen that. We're going to continue to see it. We just had the Sun Valley conference, I think, last week, and we know that some of the people that are very close and big shareholders of the company are talking about doing a deal in whatever shape or form. But I think either way, the stock price will have higher to go. So this is an interesting one, not an imminent but necessary potential. But I think if you look 3-6 months out, this is one that has a lot of upside with probably very limited downside. So a nice, interesting idiosyncratic story.
And what about US indices more broadly? Because we have obviously seen some volatility within US equities in recent months, but now we're looking at all-time highs once again, not just for the Dow and the S&P, but the NASDAQ as well. Do you think there's more upside from here as we look into the rest of the third quarter and towards the end of the year?
Yeah. In terms of the rest of the third quarter, again, I think we're going to continue to see a rolling rotation. I just don't see us getting out of this anytime soon. By the way, there's also a historical precedent to this multiple. When you get out of a recession, you have a big snapback, and then you consolidate for a while throughout the summer months. So I do think we're going to do that. I brought along a chart here, which is, believe it or not, it's the S&P 500, but it's the S&P 500 in an equally weighted format. So and this really tells you the story about what's going on in the market right now. So we've had a rolling correction. The equally weighted S&P 500 hasn't done a thing essentially since May. And the more market cap weighted in normal S&P, of course, continues to make all-time highs, largely because we've moved from the cyclical stocks into now the heavily weighted tech favors, with interest rates going lower, Apple and so on and so forth going higher. But I'm not quite sure the S&P equally weighted has what it takes to really sustainably break higher, and I think the S&P itself likely is going to consolidate here for the next few weeks at the very least, before then maybe getting a bid again as we get into the autumn period or thereabouts.
So what sort of levels should we be eyeing then in terms of that S&P potential consolidation, do you think?
Yeah, well, in terms of the actual S&P itself, I think you keep it very simple, and I'm gonna keep some very simple charts. I think I would not be surprised if we were to finally see a revisiting of the 50-day, which is currently around, let's call it 4230, so 4,230. That's nothing. It's a 3% pullback. It's going to feel like the end of the world because we've had no volatility. But I think that's a fairly logical place we could get back to, basically with a race the past few weeks of price action, which really largely, as I said, has been a function of interest rates going lower and people buying Apple, Microsoft, Google, and that, which are very heavily weighted, of course, in this indices. So I think something like that would be interesting. Can we go a few percent lower? Absolutely. But I think that's sort of like the minimum to be expected on the downside, if indeed we get a little bit of downside in volatility.
All right, Serge, thank you so much for all of your analysis. As always, it's been great chatting to you.
Thank you.
That was Serge Berger from thesteadytrader.com. I'm Victoria Scholar, and you can find more from us on Twitter. We're at IGCOP.